I want to welcome everybody for coming. I'm so excited to introduce the expert of today is Sean Aguirre. He's been a lender for over 9 years with America Pacific Mortgage. He's fantastic, and you'll find out why. So Sean, I'm going to take it away, and you can talk a little bit about yourself before we go into the presentation.
Sure. My name's Sean Aguirre, and I'm a lender with American Pacific Mortgage. I'm a San Diego native, been in lending since 2012. And prior to that, I was a school teacher. So it was a lot of teaching, education, things like that have kind of poured over into lending now and kind of have made it, made me successful as a lender as well. I live in the Oak Park neighborhood just east of North Park. And I love what I do. I love working with the pros like Michelle. So I'm happy to be here.
Well, I'm happy to have you. And as you being a native, I'm a native as well. And so it's nice to find two San Diego natives in our industry.
Yeah.
Okay, let's start with some of the questions that everybody asks. And Sean, the number one question I get asked all the time from my clients, and I always say, talk to the lender, talk to Sean, is how is my rate determined? How is an interest rate determined?
Yeah, so that's a great question. How is my rate determined? I get that question a lot, sometimes right off the bat. But the truth is there's a lot of different factors that are going to vary to know what your rate's going to be or what rates you have available. So first is going to be the type of loan that you're looking at, whether you're looking at conventional, FHA, VA, jumbo. Each loan type is going to have different rates available. The second thing that's going to go into which rates you'll have available would be the term of the loan. So does your mortgage term last for 30 years, 15 years, 10 years? And generally, the shorter the term, the lower the interest rates are going to be. So the 15-year mortgage is going to have lower rates compared to the 30-year mortgage. The biggest factor, the thing that's going to determine which rates are available is your credit score. So buyers that have higher credit scores are going to have more loan options available and lower rate options available. And then the last one is some loan types are going to have different rates based on your down payment. So for loans like jumbo options, so the higher priced loans, those options are going to have lower rates for larger down payments. So for instance, if you're buying in a jumbo loan, a 20% down payment would have a lower rate than a 10% down payment. So those are some of the things that go into it.
And a question that I always get asked all the time is, what is the difference between a conforming loan and a non-conforming loan or the jumbo loan? And we don't have to get too specific in it, but certain price points because of San Diego. I know the conforming loan is a little bit higher than in other places in the States. Mm-hmm. So can you give a little breakdown of what price point the loan would be?
Yeah, so loan limits, they change every single year and they're set by each county that you're in. So in San Diego this year, the loan limit for a regular conventional loan is 548. And any loan amount over 548 is going to be called a high balance conventional loan. When you get past 753, then you get into jumbo territory. And basically, as you get to each different loan limit, you're going to be looking at different loan products and different rates that are available. So they change every year just because housing prices are increasing, but they're based on the loan amount rather than the price of the home. So that's kind of how loan limits work in different products.
Another question I always get asked, and when I have a buyer, they're say, hey, do you think I can get a better rate at a bank, or do I need to go to Sean, the mortgage broker, who can, map out my rates?
Yeah. So for the most part, banks are going to have rates in the same ballpark, especially banks that are focused on capturing business and purchase business, everybody's going to be competitive with their interest rates. So for the most part, you're going to see banks are going to be maybe within 0.25% or less of each other's interest rates. Some banks are going to have better or more competitive products. Like for instance, a bank might have better VA rates than another one, or their strength might be jumbo financing. So really, I think it's important to kind of chat with your lender and see what their most competitive products are. But one thing to keep in mind, no matter where you're looking, what bank or what lender, is when you're being offered a rate or a rate quote, it's always important to see if there's any kind of points or an additional charge that's added to it. Because sometimes lenders, they'll tell you this is the rate, this is the payment, but they won't really make it very clear that there's going to be a cost for that particular rate or points to buy that rate. So you can always choose to pay points and buy a lower rate, but it's just important to know if the rate that you're being quoted is what you're getting, or if you're having to pay more for it.
Exactly. So many times a buyer, a first-time home buyer will say, oh my gosh, I got this great rate at XYZ, but all of a sudden the points are like crazy.
Mm-hmm.
So it's always good to know exactly where the rates are, what is going to be charged, because you have to compare apples to apples, not apples to oranges. And would you say sometimes the lowest rate is not always the best rate because of the points?
Yeah, so in terms of, well, first, I guess to speak a little bit to points, some people, they shy away from points, or they want to know, are points inherently good or bad? But they're really not. Points are just optional costs to get a lower rate, and they're going to be based on the loan amount that you're purchasing. So at more expensive prices, the points will be more expensive to buy that lower rate. But they're not really good or bad inherently. You mostly just want to talk with your loan officer to find out if it's going to be worth it. So things looking at like, first, do you have the funds available to buy a lower rate? And then if you do, it's important to look at the time period that you're going to be in this home. So what your lender can do is they can work out a time period of how long you have to be in a particular property until you're going to recoup the cost of that point. So for instance, the lender may say, if you're in the home for 4 years or more, you're going to spend, or you're going to save more via your monthly payment, and you're going to recoup those points that you paid to get the rate. So it's really just looking at your goals. How long are you going to be in this home? How much do you have available for the points? And does it make sense to kind of, are you going to get to that break even period with those points?
Got it. One of the things that I know I'm experiencing with my buyers, and I'm sure you probably are too, Sean, is this market is crazy, crazy. A lot of first-time buyers, move-up buyers, any kind of buyers, if it's not an all-cash deal, are getting cashed out, or getting nudged away from getting acceptance. And one of the things I love about you, Sean, is that you will pick up that phone call to that listing agent to explain why the buyer can qualify for this. And do you do others pre-approvals or conditional approved for your buyers so that they can compete with a cash buyer? And what is the difference between the pre-approval and the conditional approval?
Yeah. So Michelle's totally right that right now in our market, it's really competitive in San Diego. So most properties are going to have multiple offers on them. So some of the things that Michelle and I do to get our offers through when there's 5-6 other offers. Well, the first thing that you mentioned is, instead of just getting a buyer pre-approved, meaning the loan officer takes a look at everything, looks at the paperwork, looks at the credit report, and decides this is the price you're qualified for. We take it a step further, and we actually let our buyers get conditionally approved. And the conditional approval is done by someone called the underwriter. And the underwriter at the bank is the decision maker, the person that decides if the loan is actually approved or not. where myself as the loan officer, I'm more like the advisor. I help you figure out what loan types to use, how you want to structure the payment and the rate. So by letting you get an underwriter approval before you make offers, it helps your offers stand out quite a bit. So a seller's looking at 5-6 offers, they see a loan officer pre-approval, they see a Quicken Loans, Rocket Mortgage, whatever it may be, and they see a real deal underwriter approval, it's going to carry a lot more weight and really increase your chances of getting the offer approved. So that's just one of the things that Michelle and I do to make it more competitive.
Right. And which is always important, especially when you're in competing situations. And not always an all cash offer is the best offer for the seller. So having Sean as the team member, it really helps to get a deal through. Another question is, what are some of the tips to get the best possible payment? What would you recommend?
Yeah, so tips to get the best possible, the lowest payment. The first thing I would say is if you have plans to buy or you want to buy in the near future, find out where you stand with your credit score. So using sites like Credit Karma, any kind of free credit monitoring site to find out what your scores are, and then see if the sites offer any improvements, things that you can do to raise your score. Just as a rule of thumb, one of the things that's going to help your credit score is to keep your credit card balances, keep them generally low. So you want to keep your balance or what you're borrowing to be around 30% or less of the total max that you can borrow. So if you have a card with the $10,000 limit, don't charge more than $3,000 to it, because as soon as you start going higher than that, your credit score starts to get impacted. So first, just trying to check out where your credit is. Things like if you have old collections or any kind of old items on your credit, call the creditor or the collection agency and say, if I pay this, will you give me a deletion letter or something to verify that the collection is going to be gone? Because if you can get that removed from your credit, then that's going to do wonders. And then something that I did personally before I bought is I used a credit repair team. So I would say chat with your lender or a realtor to find a good credit repair option. But what they did for me is they got off some old derogatory stuff, some old late payments that I had from college, and it raised my scores up so I could qualify. So credit, I would say, would be the first thing. And then second is really look at your options and talk with your loan officer about what you can do to structure the monthly payment to get it as low as possible. So a lot of people, they won't even consider buying, or I've heard at least, I don't have 20%, I don't want to buy yet because I would have to have mortgage insurance, which would be an additional amount they would have to pay. But there's really creative things you can do with mortgage insurance, especially if you have great credit, to eliminate it. So for instance, I have clients that have bought with just 5% down, and instead of paying a monthly mortgage insurance, they chose to pay it in full upfront. So what they did is they paid their down payment, they paid the mortgage insurance in full, and then the result would be their payment moving forward had no mortgage insurance. And the whole thing ended up costing them less than, I think it was like 8% of the price of the home total. And they had a loan with no mortgage insurance. So really just explore your options, see what you can do to raise your credit score as high as possible. So that way you have the most loan options with the rate, the mortgage insurance, and things like that to keep your payment low.
One of the things I always tell my buyers once they get into escrow, especially if they're getting a loan, do not make any major purchases and explain to them why you don't do that.
Yeah. So when you get pre-approved, the lender is approving you based on what your credit, income, and your assets look like at the time that you sent all your documents in. So let's say you get into escrow and everything's moving along. but you decide, I need some more furniture, I need some new cabinets for this home. So you go to Home Depot, open Home Depot card, charge up all these appliances. What happens is if you make any major changes to your credit, that's going to change your qualification on the loan. So if you're close to the max of what you can qualify for and you charge a lot of new appliances or furniture on your card, it could put you over the limit of what you can qualify for and disqualify you from the house. So in general, you want to keep your credit and your purchases the same as they are at the time you get pre-approved. So wait until you have the keys before you go start trying to get new cards or making any big credit changes. That's really important.
Exactly. And with especially one of the most important things is when you do run your credit, there's no surprises.
Mhm.
And there's also a thing that people don't realize this, but Sean, isn't it true? Before the loan docs even go out, the lender calls your employer to make sure
Mhm.
that you are still employed. So don't quit the job.
Yeah, and that's really important too. Is you want to, the main takeaway for my clients or for anybody that's getting a loan is if you have a change or any kind of any kind of change, talk to your loan officer. So I have a client in escrow right now actually that she changed her job in the middle of the loan, and the type of employment was not the same as what she was doing, so it disqualified her income completely. So thankfully, we made the loan work with just her husband's income. But things like that, if we would have had conversations and kind of game planned, we could have structured it and made it happen in a way that we wouldn't have to delay anything or risk the loan not closing. Yeah.
Well, we have some questions that in the chat. So one of them is what can a buyer do to set themselves up to get the best possible interest rate? For example, 2 years out, 1 year out, 6 months out, etc. On the flip side, what should you not do?
Yeah. So I would say no matter the time period, if you think you have to do it soon or far in the future, is I would start with a credit monitoring site like Credit Karma or a free, there's a free credit report. I forget what the website is, annualcreditreport.com, but get a copy of your credit report or see where you stand at the moment. And then from the credit monitoring site, you'll be able to see if there's any tips to raise your scores. So check and see if there's any negative things on there that you can call the creditors and ask for them to remove, things like that. Sometimes it's just paying balances down, adding your name to, let's say you have a family member with excellent credit with a card that's been around for a long time. See if you can add yourself as a user on that card with someone that you trust. So that way you can have that excellent credit history rub off on you too. So yeah, I would say find out where you are and then see what kind of suggestions you can do to get that score up.
And sometimes when you do run the credit, all of a sudden if it's a first time home buyer, they might have gone on a bank card with their parents, not realizing that they were on it. And all of a sudden that balance comes on their credit, correct?
Yeah. If you do add yourself to somebody else's card, that will show up in terms of your credit report. So it could increase or it could help your credit score if it's a good history card with a low balance. But you're right, if it is a card that has a high monthly payment, then that debt may end up counting against you. So I would say something with a low balance, low payment would be a good move if you wanted to get better credit.
Okay, another question we have is how does someone know how big of a loan that they can get? Is it all based on credit? Is it income? What are the other factors that determine this?
Yeah. So credit, it has an effect on what price you can qualify for, but the way that the bank figures out what price you can qualify for is by comparing your monthly income versus your monthly debt plus the proposed housing payment. So the payment of whatever house that you're looking at. And using those numbers, that's how we figure out what you can qualify for. So what it means is the more monthly debt that you have, the lower the price you can qualify for. So some people worry about things like student loans where maybe they owe $100,000. But if you're in an income driven repayment or a payment plan that keeps the monthly very low on that loan, we have certain loan types where we can only qualify you using that small monthly amount and not the balance of the student loans. So the short answer is we figure out what you can qualify for based on your income versus your debt. So less debt, more options.
And that's why for my buyers, it's always so important. I want them to fall in love with something that they can afford and not afford, and what they cannot afford. So the number one step for any home buyer is talk to Sean, the lender, to make sure that what you can fall in love with, you can afford. And the nicer thing is sometimes they find out that they can afford a lot more, especially with the interest rates as low as they are.
Yeah. Yeah, the pre-approval is really just step one. It's not locking you into a loan. It's not obligating you on anything. All it is finding out what price you qualify for and finding out if you're comfortable with that payment. So that way you can kind of decide, do I want to go and shop for a house at this price, or do I want to go less or more? Yeah, pre-approval is really just step one.
And another question is how often do you see a FHA loan? Are you doing a lot of them in San Diego or more VAs?
Yeah, so I don't do too many FHA loans, but one advantage to an FHA loan compared to conventional, for instance, is if you're looking for 2-unit properties specifically. So FHA will let you buy a 2-unit property with the same down payment as a 1-unit, only 3.5% down, where conventional loans, if you want to buy a duplex, they're going to charge you at least 10, 15% down to get it. So that would be an advantage of using an FHA loan there. But in terms of how often you can get an FHA loan, usually people are only going to have one FHA loan, but the guideline is something like if you're going to purchase a second home with the FHA loan, you have to be a certain distance from your original purchase. So I think it's 100 miles or so. But usually only one FHA loan at a time.
Okay, and the VA loans. San Diego is a military town, and there's a lot of VA buyers. And what do you do a lot of VA loans, Sean?
I do, yeah. I'd say about half of my business is VA. And there really isn't a better loan option on the market. VA lets you buy with no down payment. The rates are going to be the lowest in terms of versus conventional, and you're not going to have any monthly mortgage insurance. They also removed the county loan limit, so you can buy a home at any price with a VA loan without a down payment. So you can get, 1.5 million, $2 million house with no down payment. There's no other loan option that will let you do that. So yeah, you really can't beat the VA loan. So if you do qualify for that, it's 9 times out of 10, it's going to be the best option.
And I think too, what's great about a VA loan, years ago, if you could only use it once, and now you can use it over and over again. And the only stipulation for the seller is that they have to pay for termite work. They have to get a
Right.
termite clearance on it. That's the only thing. They don't have to do any repairs, but they do have to do a termite report and get a clearance on it. So
Yeah.
another question has been brought up is, can you explain the process of a cash out refinance works?
Yeah. So a cash out refinance is when you're an existing homeowner, and let's say you bought and you have some equity in your house. Your home is worth more than when you bought years ago or whenever it was. A cash out refinance is it's a new loan that's going to pay off your old one, and it's going to give you some money back. So you can borrow from the equity that's in your house and you can do whatever you want with it. Some people do cash out refinances to pay off debt. Other people do it for home improvements. And then sometimes people do it to purchase other homes. So one advantage of this crazy market that we're in, that is basically prices, they seem to be high. Sellers might seem like they're in control. If you're an existing homeowner you have a whole lot more equity than you did this time last year, just because the prices are going up. So a lot of my clients are taking cash out of this equity that they didn't have last year. So that's a huge advantage right now if you are a homeowner.
Thank you all for being here. And if there's no other questions, let's say goodbye and see you next month. And of course, Sean, thank you for everything you've done. I'm Michelle Silverman, your global luxury realtor in San Diego for the past 30 years.